Good afternoon. Is inflation back for real? This is the question that we're going to be discussing at this panel today. At the start of the year, Isabel Mitchell, the programmer of Global Borrowers, and myself make a load of phone calls to delegates on what topics we need to cover in the conference this year. What are the hot topics? Occasionally, some people say we should discuss inflation. This year, though, was very different. This year, I think, for the first time ever, almost every single one of those conversations said, yes, you do need to discuss inflation. That's a key topic. So I'm delighted now to be able to deliver on that. Help me do that, you have the panelists that you see in front of you. Let me briefly introduce them. Steele from the US Treasury is responsible for the issuance for the American government, the largest issuer of inflation-linked bonds in the world. Joe Whelan, the Deputy CEO of the UK Debt Management Office, which I guess is the longest standing issuer of inflation-linked bonds in the world. From the buy side, Lindsay, Politi, the head of inflation strategies at One River Asset Management, and Karen Ward, the chief market strategist for JP Morgan Asset Management. And we can't discuss inflation without an economist, so delighted to also introduce Gabriel Stein, an independent macroeconomic commentator and forecaster, and for regulars at these events, you'll know, one of our most regular speakers at Euromoney events. Thank you all so much for coming along today. Let me start with Gabriel, if I may, with the one big question. Sudden uptick in interest in inflation. A lot of people are blaming COVID. Let's hope and pray that COVID is a short-term thing. Is the inflation also short-term?
No, I fear that it is not, and for a number of reasons. Perhaps most importantly, at the end of the day, inflation is a monetary phenomenon. We have seen extremely rapid monetary growth in a number of countries. In the United States, the fastest they have ever had in peacetime, for instance. Not quite as fast in the euro area and in Britain, but still much faster than before, even picking up in Japan. That's one reason. Another reason is, at the moment, everyone wants inflation to some extent. Central banks want a little bit of inflation so that they can show that they are achieving their targets. And governments want rather more inflation because governments have borrowed huge amounts of money. And sooner or later, they will need to roll that over. And it would be amazing if interest rates at that time are not higher than they are now. And so, say, 2 years of 5% inflation would do wonders to erode the real value of the debt. So I am afraid that we are going to see inflation higher than central banks currently are expecting. 12-month numbers will drop during the summer. But then that's because of the base effect, and the base effect reverses in the autumn. So expect numbers around 5% or more at the end of 2021 and going into 2022. And at some stage, central banks are going to have to say this actually isn't transitory or pretend that it is, and then everybody had better get used to it.
Karen, would you agree that it's also a long-term phenomenon and Gabriel's point that we all want it?
Well, I certainly think governments would like it. If we look to after the Second World War, the last time we had debt levels of this kind of magnitude, over the next 15 years, actually, governments grew into that debt fairly easily, and real growth and inflation was a key part of that. So I think the desire is there, but I think in the markets at the moment, the question isn't so much about the desire, it's about the ability to generate inflation. And I just wanted to pick up on a point that Gabriel made about it being a monetary phenomenon. I think many clients say to me, well, hang on, QE, monetary expansion last time didn't give us inflation in the last cycle. So why would it necessarily be the case this time? And I think there are two important additions to the story that Gabriel's highlighted, which is that central banks now have a partner in delivering inflation. And that partner comes from governments, and it comes from the commercial banks. If we think about the last cycle, you had the monetary authorities with their foot firmly on the accelerator, but governments and the commercial banks, through austerity and deleveraging, with their foot firmly on the brake. So the central bank was creating all this money, but had no partner to actually get it circulating. And that is what's different, I think, as we come out of the pandemic, and why we should certainly question whether this inflation really is transitory. And I think I do sit with Gabriel that it's not going to stay at 5%, but I think 2 to 3 is more likely over the coming years than perhaps the 1 to 2 that we had got used to in the past.
So Lindsay, so both Karen and Gabriel are both saying yes, inflationary for different reasons, because we want it, because we have the ability in the banking system and fiscal. What's your view?
I guess as an investor, I come at it from a slightly different perspective, looking at it as sort of a balance of risks. And when I look at the risks, I look at the fact that the Federal Reserve has bought $4 trillion in assets over a little over in the past 15 months, doubling their balance sheet. The ECB has bought another $4 trillion in US dollars. Central banks around the world have been buying a tremendous amount of assets, and their footprint in the financial markets is just unprecedented in any historical context. So maybe this inflation is transitory, but if it isn't, and this needs to be unwound, the impact for the markets is pretty dramatic. So then we could end up in a situation where either these central banks need to start selling financial assets at a much more rapid pace than they were expecting, creating significant market disruption, or they decide to not tighten policy as quickly as they might need to, leading to a significant inflation problem. So I think that probably the biggest risk to the financial markets right now is inflation. Whether or not it materializes, I think that everyone should be in financial markets should be considering how their portfolios should fare.
Nick and Joe, I'm guessing that you can't comment on this, and that you won't be allowed to by your media minders, but feel free to join in if you do feel able to. But if you can't, Lindsay, can I stay with you? So given that, and looking at the market at the moment, it seems to me that break-evens in the inflation bond market seem to be suggesting an outcome over 5 in 5, for example, of more than the Fed's target rate in dollars, higher rates across all inflation prices. Do you believe that is the case? And does that mean that the market is saying the Fed can't control inflation, the Fed doesn't want to control inflation? What's your take on that?
Yes, so I actually look at the inflation-linked bond break-evens in the U.S. as being relatively sanguine about the inflation risks. So, if we look at the difference, the Fed is targeting a 2% core PCE because of methodological differences that would equate to a headline CPI of around 2.25 to 2.5, which is exactly what inflation break-evens are pricing. And this is sort of the long-term range in the past that was associated with the Fed achieving its long-term inflation target of 2%. So right now, there's really not much overshoot being priced into the markets. And this is even more clear if you break down and look at inflation as a series of 1 years and forward basis. And there's some pricing in of short-term high inflation, but rapidly falling back to the Fed achieving its target. So, in terms of a risk of an overshoot and an opportunity to look to the inflation market for hedges, I still think there is opportunity. I don't see a large overshoot being priced into the market at this point.
Karen, I appreciate that it's difficult and there are many ways to look at break-evens, and I guess we're not specifying whether talking about dollars or all currencies, but do you believe the market is pricing in the Fed and other central banks overshooting their targets?
Well, I think just the price action over the course of this week has been very interesting. I think when the Fed came out from this meeting and said that they had some ceiling perhaps of their tolerance to inflation, because of course we don't know. We've got this new framework, average inflation targeting, but it's a very vague framework, so we don't really know what their tolerances are. But I think the fact that they bought in some of their rate hikes, the market seems to have interpreted that as, that true reflation, inflation getting ahead of itself is something that the Fed won't tolerate. I think there's an interesting other angle for investors to think about, though, which is that I think the forecasting community, markets, absolutely believe that if inflation does pick up and they wish to stamp it out, they have all of the tools at their disposal to do so. And I think that's not necessarily 100% true. I mean, if we think about prices rising because of supply bottlenecks, but then wages starting to pick up and governments increasing unemployment benefits in order for those households to be able to afford those wages. I mean, I notice in the UK there's call for some of the unemployment for some of the tax credits for low income households to be extended because of rising inflation. Politically, that's quite hard for them to lean against. So again, this is kind of tail risk stuff, but I just think we need to be very careful with using some of the assumptions that I think we've all pinned down over the last cycle, such as it's not possible to generate inflation. Even if it turns up, the central banks have the ability to stamp it out. I think we need to question very many aspects of the inflation narrative.
The political thing is an important one because it touches to that first point about whether central banks are truly independent of political pressures. Gabriel, I'll ask you that one. Can I also ask you about average inflation targeting rather than hard 2% targeting? Is that a deliberate way of obfuscating the lines?
Well, it depends who you ask. To some extent, it could be seen as a variant of price level targeting. In other words, if we have undershot, we have to overshoot. But you have to ask yourself, would they be prepared to undershoot in the future if they overshoot? And as Karen has pointed out, it's very vague. When did the undershoot start? For how long do they wish to overshoot? Is there a target for the consumer price index? I have a feeling this is more an issue of allowing the central bank to do whatever it wants. And by the way, the ECB, of course, hasn't announced that they will practice AIT, but from time to time, Christine Lagarde is talking about it. So it may well spread. And it does fit in with many of the points that Karen made, and with which I agree with, that no central bank is going to be allowed to, in the old words, take away the punch bowl, to abort the recovery. Governments are terrified of another upturn being halted in its tracks. That would be seen as unacceptable. And what you have seen is also over the past 13 years, really, central banks, which once upon a time were all powerful. Remember when central bankers were demigods, except Alan Greenspan, who was really God? They're not anymore. Power is a zero-sum game. Power has flowed back to governments. Central banks will be pushed into allowing higher inflation. And this comes back to the question, will the Fed tolerate? Yes, they will have to do it. It was, I believe, was it Arthur Burns who said the Fed has to do what the president and Congress wants, otherwise they risk losing their independence? That will be true elsewhere as well. It's deeply worrying, I think.
And part of that loss of independence because of the fiscal expansion, because they can't step on the monetary brake to cancel the fiscal expansion, you mean?
It is partly for that reason. It is partly because, strangely enough, it turned out that they weren't all powerful. They couldn't fix everything. They did a fairly good job. Partly also because nowadays we have in power almost, well, not almost everywhere, but in a large number of countries, in Britain, in the United States, among others, in a number of European countries, we have governments which, regardless of their formal political color, are de facto populist governments, France as well, which means we want to spend. Because spending gains us votes, we think, so we want to spend. And then you come back to the point you just said about they can't, they won't be allowed to break with the fiscal policy, essentially.
They want to spend, and somebody has to fund that spending. So let me turn to Nick and Joe on that.
Beyond the next election.
Well, debt management offices have to survive politicians of all colours. Could ask you about that, Nick, but no, I'd rather ask specifically about how many inflation-linked bonds do you raise? You've had a year where borrowing for every country on the planet has increased massively, where inflation has been clamoured for by the market. How do you determine the percentage or the absolute number of inflation linkers that you issue?
Sure. So I should probably reiterate just to start that Treasury adheres to what is known as a regular and predictable issuance paradigm, in which we issue across all maturities and security types in all interest rate environments. Empirical studies have shown that this approach both minimizes volatility for investors, but also minimizes the cost of issuance to the taxpayer. Therefore, we take a long-term view of interest rate cycles, and we don't change our issuance pattern based on short-term interest rate or economic fluctuations. So in terms of TIPS issuance, Treasury is currently increasing TIPS issuance across the curve, a program that we began in January of this year. And at our most recent quarterly refunding announcement in May, we reiterated our expectation that total gross TIPS issuance would increase gradually by about 1 billion each month for a total of 10 to 20 billion in calendar year 2021. So allowing us some flexibility within marginal changes over the year, depending on the way that supply and demand played out. These planned increases are essentially designed in order to stabilize the amount of TIPS outstanding relative to our nominal issuance, which we increased dramatically last year as the main tool to fund the fiscal stimulus in response to the COVID-19 outbreak. So we decided last year not to increase TIPS for the time being, which is a typical pattern where we will make our first adjustments in the shortest duration nominal instruments of bills, which we consider our shock absorber. And then we'll roll out to longer and longer maturities across the nominal curve. We do think of TIPS as a separate asset class with its own dynamics. So we often will take a bit more time to talk to market participants and do our own research before making changes to the TIPS program. And hence our announcement last November about our plan to gradually increase this year. TIPS had declined from about 9% of total outstanding due to the nominal increases last year to around 7.5%. And it's our goal to first stabilize the amount outstanding, and then if demand stays consistent, we may gradually increase back up to around our historical average, which is 9%.
Very clear that you always have tried to adhere to that transparent and predictable, but really the market must cut you some slack in a year like this. You must be able to do more than just short-term bills without disrupting. And presume you have investors calling up, clamoring for more TIPS issuance. Isn't there pressure for that, or you know you really must stick to the year plan?
Well, we've certainly seen increased demand, and that's why we're responding to it by making these gradual increases. But we often like to study the market and then make increases over time. And part of the reason for that is, when we're issuing large amounts every single month. And when we make changes to our issuance, we often will maintain those for many years to come. So when we think about demand for inflation-linked treasuries, TIPS, we think about if we make an increase in issuance this year, how will that play into the demand that we think will be around for the following many years to come. And so we've been very pleased as we increased this year that demand has stayed very high. And that's why we've continued to increase over the year. Later in the year, we'll reassess and determine whether the demand seems to be consistent, and then make a determination for what we'll do next year.
Right. Joe, you've seen the increase in demand at the sharp end. You recently did a 4 billion transaction, and I think you received nominal 29 billion. Got it in my notes somewhere. 29 billion of demand for that 4 billion issue. Did that reflect froth because it was clear it was going to be oversubscribed? How on earth do you think about the allocations and managing such a phenomenally oversubscribed book?
Well, I mean, it is a quality problem in a way, isn't it? I mean, it's great that we can bring to market something and it goes so phenomenally well. I would say, though, that this trend for order books be much larger than the amount that is plausibly available to buy it's not just a thing that is about what happened in May for us. It's been going on for a while. It's a feature of other markets too. I know some international colleagues have the same experience. And how do we deal with it? Well, to some extent, if we're thinking that it's reflective of very strong demand on the day, then we have a little bit of latitude to amend how much we actually issue. So in that particular case in May, we were able to increase the
Is it just me or has everybody else lost Karen's sound there? That's sort of Joe's sound, sorry. I think we have lost Joe's broadband there. Whilst we're waiting for Joe to come back, Karen, can I ask you about the maturity of issuance? And I guess this talks a little bit to what we were saying earlier about how transitory it is. But what do you think about the optimal maturity for the issuance? 3 years, 5 years, 30 years?
Yes, well, I think it comes back to this question of, transitory, and at what point will those medium-term inflationary pressures build? And I think the answer to that question is in the labour market. We're all asking this same question of, is it transitory? Is it medium-term? And it will be the labour markets that dictate that, because if wages don't go up, then inflation has to prove transitory, because nobody's got more pay to go out and spend, so they have to cut back, and that either forces a relative price shift or forces inflation back down. If everybody, however, gets that pay rise, then that sort of gives a new leg to inflation. So, wage growth is the underlying, I would say, indicator of sustainable inflation. It's certainly what all the central banks have always told us to focus on with regards to medium-term inflationary pressure. And I think by the end of the year, it's going to be very clear that labour markets are tight and workers have got bargaining power. So I think at the moment, inflation is going to come down from the 5%, how quickly it does, but I do think it will moderate to some degree. But I think it won't come down quickly enough before those underlying pressures really start to gather a bit more steam, and some of those core components of inflation are really starting to pick up as goods inflation moderates. So I think that suggests a sort of 3 to 5 year, perhaps, where there's underpricing as I look at it in the market. I definitely think that the overall consensus, has absolutely bought what the central banks have told us, which is that this is transitory, it's going to go up and come down, and we're going to be back in the world that we used to know before, low inflation, etc. So I think that's where the potentially interesting opportunity is.
Lindsay, I'd like to ask you the same question. Before I do, though, let me welcome back Joe. We had some technical there. But if you could, please continue with your comments about this.
I am so sorry. I'm not quite sure where I lost you or what happened there.
Things happen.
So sorry about that, but things happen. Yeah. So, the information value, I think, in these very large order books is a little bit less clear than it used to be. So I wouldn't read too much into that. But as I was trying to say, it's a phenomenon that is really exhibiting itself around the world. In terms of, what is the right balance of index-linked issuance for us, going to some of the points that Nick was making earlier, I would say there's no one kind of specific optimal amount. We do in the UK have a general policy to bear down on the amount of issuance that we're doing in index linked, with the background being that we're coming from a very, very different place to Nick, and we're looking to kind of get the amount of linkers in the portfolio coming down to a stable level, opposite way around from you. Also, Richard, as we've talked about before, we have some idiosyncratic reasons in the UK with the consultation on RPI reform last year, which meant that we had a slightly lower issuance last fiscal year. So this year we have actually been increasing the proportion that we're issuing in index linked, but I would say it's very much in that longer term strategic context that Nick described, rather than specifically in reaction to, you know, a particular opportunity in the market. Thanks.
And thank you. And Lindsay, sorry, I cut you off in responding to Karen to let Joe. What are your thoughts on the optimal maturity?
So I think that, especially in the US, we don't have the pension funds with the cost of living adjustment. So we don't have a natural buyer for the long end like there has been in the UK. But I do think that we have increasing demand for inflation type hedges from just more traditional investors. And for them, I think that once you get out, especially beyond 10 years, but even to a little bit at the 10-year point, the real yield duration becomes so large that it really outweighs the inflation protection unless you're able to hedge that duration risk. So to me, the shorter maturities are better, and I think would even be nice in some ways to get maybe a 2-year tip issue, something like that. I think that's just a natural fit for the investor base in the US.
Nick, that naturally leads to you. You spoke about transparent and predictable in terms of the percentage of tips versus nominals. What about the maturity breakdown? Does that also apply to 2 years, 20 years, 30 years?
Unsurprisingly, it still applies. But we've certainly heard, you know, the feedback that Lindsay mentioned in terms of, you know, relative demand, and it is something that we monitor at a high frequency. You know, we only issue at 5, 10, and 30-year maturities. So she mentioned a 2-year maturity. That would be something new. And those are the types of things that we're always thinking about, gathering feedback. Anyone who's been in the space for any time knows that we're not known to be the most rapid decision makers in that regard, but it is certainly something that we're considering all the time. And if there's sufficient demand for additional maturities, we will launch them, just as we did with the 20-year nominal maturity or the 2-month bill most recently. But we have made some changes to our TIPS calendar. So maybe just to take it back a moment, in 2018, we conducted an extensive year-long market outreach campaign to TIPS market participants in general, primary dealers, and also consulted with our Treasury Borrowing Advisory Committee. And the most significant result of our analysis was that there is a relatively high amount of demand for shorter maturity TIPS. And so that led to our introduction of an additional new issue in our calendar of the 5-year TIPS. So it used to only be a new issue in April. Now there's also one in October. So in addition to responding to additional demand and allowing us to focus our issuance increases at that maturity point, it also provided investors with a 4th calendar quarter TIPS maturity, which was not available previously. And the thought behind that was to allow for better pricing of seasonality in CPI by having that point. You know, since making that change, we've continued to ask investors about their preferences, and the 5-year point continues to get a lot of demand. So, you know, that is an area that we could consider if we were going to focus our issuance slightly more at one maturity point in the future. We could consider that, but we also have to keep in mind, you know, is this cyclical or is this structural? And so, in thinking about structural demand, we have heard that there are very healthy flows into shorter dated ETFs and mutual funds that focus on TIPS, as well as a natural allocation from target date funds as they roll towards the retirement date to roll into shorter maturity TIPS as well. And so in addition to kind of the current preference for many investors focus on shorter dated TIPS, because you have less real yield duration and more direct inflation exposure, we also see structural trends moving in that direction, and hence the decisions that we've made in the past and how we're thinking about it moving forward.
Mm-hmm. And Joe, as our other issue, what are your thoughts on the structure of demand in terms of maturity and how to feed the clamoring masses?
Well, I think in our market, actually, we don't have a very strict benchmark maturity type approach as you do. We do that more on our conventional side, but less so in the index-linked market. And there we regularly see calls for issuance across quite a range of different bonds. And there tends to be a cyclicality connected with where pension fund hedging strategies have got to, where the sweet spot for them is. But in the last 18 months or so, we've issued quite a lot of shorter dated index-linked bonds quite successfully. It's been really helpful. Typically, historically, we found that the better value for us as an issuer is from 10 years and out rather than in the very short end. And it's not really come to us as a plan to issue something as short as 2 years. That would be less likely, I think, to be of value for us as an issuer.
We've had a question from the audience. Thank you. We always love to get questions. Please pop them in the chat box if you have any thoughts on what we're saying. The question we have had, though, is which market is most in denial about inflation and why? They've narrowed that down to sterling, dollars, or euros. But Karen, who do you think is the most in denial about inflation?
I'd say the European markets over the US. I mean, as I look, markets to me forward pricing tends to be very closely linked to the experience we've had over the last 5 years and what the central banks think inflation is going to be. And in the UK, I think inflation is going to be much higher than what the Bank of England predicts it's going to be. In fact, they're already way away from the projections that they last set out. So I think that's one area. But I think in Europe possibly is where it could be most interesting. I mean, I spoke earlier on about how I think investors still very much believe in the secular stagnation, low structural growth and inflation of the past. And I think nowhere is that more clear than in the Eurozone, where Europe turning Japanese, I think, is a very firmly embedded expectation. Whereas, my point is that I think the fiscal austerity of the last cycle played quite a significant role. And as I say, I think that is turning in Europe as well. So perhaps where you could get that repricing in terms of inflation expectations with less duration risk that Lindsay pointed out, because I think that's a really key point. It's not just about what you think inflation is going to do, it's whether your duration risk wipes out your return that you've created on that inflation expectation. So I think I would say actually counter to what people think probably is where the inflation risks are, that actually it's Eurozone where it has the potential opportunities in markets.
Japanification expectation, is it, rather than just a fear? I didn't scared that it's been upgraded. Gabriel, what's your thought on this?
Oh, I definitely agree that it's Europe, and it's quite interesting because on the one hand, if you look at the monthly business and consumer surveys from the European Commission, inflation expectations are surging. In particular, in manufacturing, selling price expectations over the next 3 months are just shooting up. I mean, I haven't seen numbers like this for a very, very long time, but markets seem to be very sanguine. I think one reason markets are sanguine, and we've seen that to some extent in the US as well, is because they believe in the central bank. Moreover, in contrast to the US, the ECB is much more independent than the Fed. And of course, euro area inflation has been much lower than American. We haven't seen anything near like 4 or 5% coming out of the euro area. So I think there's a feeling that we're going to be all right here. You could argue, and I agree with Karen there, you could argue that perhaps that's because the euro area is actually a very weak growing area in general. So maybe it's not such a good thing. But I definitely think they are the ones who don't believe it's going to happen.
Mm-hmm. We've been talking about inflation as if it's just one number. Clearly it isn't. And clearly that is an issue in the sterling market at the moment with the, well, there's always been a divergence between RPI and CPI. And now there's efforts, Joe, to reform RPI. And there's been quite a lot of press about the implications of that for investors. Why are we reforming RPI? Is it the right thing to do? What's the thought process?
Sure. Yeah. Well, there's an independent statistics authority that is charged under our legal system to make sure that the quality of statistics is maintained. And there's been a long debate for quite a few years about the merits of the calculation method used in RPI and some of the other characteristics around it. There was even a House of Lords inquiry on the topic, and the Statistics Authority made the decision to rectify the way that the index was computed and so on, and that was all decided. We then had to hold a consultation about the appropriate timing of that, because there was a small role for the Chancellor of the Exchequer to validate the decision made by the Independent Statistics Authority. So in terms of how that changes it, the plan is to bring the methodology and of the CPI and use that for the RPI. And so that would mean, in effect, that from an investor's point of view, the type of inflation index that they would be tracking would be moved from being two different things up until the year 2030 to being very, very closely aligned going forward, which is, I suppose, is kind of helpful in one sense, that the people can then focus on just targeting one type of inflation. But to your point, I think, there are always going to be different users of inflation at large, and some people will target specifically RPI, some people will target specifically CPI, but some people will actually be targeting something that is different, that is, maybe capped by one or the other. And our policy has always been to reflect in the product that we provide the sort of benchmark, the most generally used item, and then the financial markets can create derivatives based off that to try and manage all those particular specific needs that other actors have in the market.
We've been talking a lot about bonds, naturally, but that isn't the traditional, isn't the only traditional inflation hedge. But Lindsay, gold would be a more traditional inflation hedge, wouldn't it?
So to me, gold isn't so much an inflation hedge, but a real yield proxy. So sometimes lower real yields does lead to inflation. But part of why gold hasn't performed as well this year is because higher inflation expectations, especially in the US, have come with, at certain times, with higher real yields. So in terms of looking at other proxies, I think that inflation-linked bonds are nice because you have that direct feed to inflation. Other hedges like gold or like Bitcoin hedge specific types of inflation or things related to inflation, but not inflation directly. So you can get, maybe some surprise underperformance if inflation comes in ways that aren't expected.
Mm-hmm. 40 minutes into the panel before anyone says Bitcoin. That's quite good. Karen, what do you think about this, about the alternatives to fixed income products?
Yeah, well, I think there certainly are things to think about. Most obviously, if we look to real estate or infrastructure, if we go back to the period of the 70s, the only thing that really provided you with real returns over the stronger inflation periods were those real assets. I think regulated utilities, things where their earnings, their cash flows are linked to inflation, and therefore that you're sort of protected. So I think there are certainly areas, but it's going to be difficult. I mean, I think we have to all acknowledge that if we do see persistent inflation, then it's not going to be good for our bonds. It's not going to be good for our stocks either. And I think finding those inflation hedges is well worth our homework at this point in time.
Mm-hmm. Gabriel, your thoughts on that?
Well, again, I agree with Karen. It's so nice to agree with. It's nice to agree with one person, but not with everyone. So that's really great. Gold, not surprised. Gold is not now, nor has ever really been an inflation hedge. That is a myth, as so many others. On what might be an inflation hedge, and what I actually think is going to be something important going forward, it's not just real estate, but it's something which, at least in Britain, doesn't really exist as a separate asset class, and that is residential rental real estate. I'm talking about what you can see in continental Europe, in Germany, or in Sweden, where I come from, and the other Nordic countries. A proper residential rental market where people have indefinite tenure and so on, and where that sector is actually quite large. And we can have negative interest rates, but we have not yet come to a stage where where landlords will pay people to live in their buildings. So and if you then add in that we're not building enough houses and massive house price inflation, pricing people out of the large cities and so on, I'm feeling that might be, going forward, a good alternative. But it may take some time.
Sadly, we do have to end it there, which is incredibly frustrating because I have a load more questions I would like to ask you. I'm very frustrated. We are strictly on 45 minutes, but we are. Thank you to you all for stimulating conversation, very wide-ranging conversation. So I've learned a lot. And thank you so much to you in the audience. And I think we've got about a minute left. So can I just indulge one personal comment, as this is my final session at Global Borrowers for this year. For several years now, Global Borrowers has been programmed by Isabel Mitchell. Some of you will know Izzy, many of you won't, but she's been basically responsible for this conference for about 5 or 6 years now, choosing the topics, finding these excellent speakers, liaising with the sponsors and moderators, which is an incredibly difficult job. I know I couldn't do it. I'm just a consultant. I turn up and I read the questions. Izzy is the real brains behind the event, but sadly, this is her last year organising it. She is moving on. So on behalf of all of us, I'd just like to say an enormous thank you to Izzy for all of her work over many years, and wish her all the best in the new challenges. Thank you once again to my panelists. Thank you to you for watching. Please stay tuned for the final session of this year's event in about 15 minutes' time. Thank you.